Hello, welcome to my channel. My name is Toof, and I'd like to welcome you for a new stock analysis. This one in the mining industry, and the name of the company is GeoDrill, like $100+ million market cap company, trading under the ticker GEO in the Toronto Stock Exchange. First, I'd like to give some credit to the to Florent Buchneck, who's one of my favorite retail investors that I'm following. He's got a great research group that is hosted by the website recordinvestor.com. So I will put actually the link down below, and actually you can just subscribe for free on his room, which is actually Florian's room. So then let's start with the company. This is a drilling company that has been actually in the business since before 2000, 1998. They started with one rig, and obviously over the years, they increased their rig fleets up to now more than 70. The location of these rigs is mostly in West Africa, so in Ghana, Mali, Ivory Coast, and Burkina Faso, but they recently expanded into Egypt and Peru. We'll see that a little bit later on the slide. Also, what is actually interesting is that they have been accumulating great news over the recent months, so starting in 2022, by actually increasing their, let's say, future contracts. And here's the summary of 3 of them. So there was one first, which was like $45 million over the coming year with a company called Perseus Mining in West Africa. A second one announced in February 1st regarding Egypt, which is actually a new business, at least a new geographical footprint, which actually is one of the biggest contracts that they've ever signed, which is $54 million over the next 5 years. And also in February 23, they announced another big contract of $31 million that will be completed within the next 2 years, again in West Africa. All these numbers actually are comforting potential investor, because if you add up, it's more than 1 year of revenue. So in total, $130 million, which will actually, let's say, ensure that you will have at least some baseline on the revenue. Also, they reinitiated their buyback program. So just for information, this buyback program was already in place in 2021. They had not exercised any buyback. Possible reason for that is the share price, was not really low over the last year, but also they prefer to invest into their capex, because they understand that whenever you have cash, you need to use it let's say the wisest way. And it seems like the CEO made a choice of investing into capex for future revenue growth rather than investing in the buyback. However, this buyback program is still in place, meaning that anytime there's a weakness on the share price, they might be able to reduce the number of shares. So that's what I'm mentioning. Good opportunity. It will also possibly provide a floor to the share price and boost obviously the EPS in the long term. However, the total buyback program plan at the moment is only 5% of the shares, so it's not a massive amount, but still decent. Another part of the presentation, which actually is very interesting, and actually that just puts, let's say, more attention to me, is that over the last years, they were in a down cycle. Also, COVID played a very bad role in 2020. But 2021, the backlog could actually be exercised. And what the tendency is that the revenue increased by 40%, but the bottom line increased even more. And that's actually what I call it operating leverage, which is very interesting when you want to invest in a company. So EBITDA increased by 55% and net income by 88%. Okay, so it's unbelievable. Net margin on the 2021 was around those, so this 12.2%. Now let's look at the DNA card, because for me this is where I summarize the entire metrics, and we'll go through this DNA card step by step to show you what are the strong points of this company and if there's any weak points. So at the moment, I'll zoom in. Okay. The first step usually in the process is to calculate the enterprise value. It's basically the market cap value, $124 million, that is corrected with the amount of cash or debt that the company owns at the moment. From the balance sheet, you can see that the cash and equivalent is 15 million. They also have 2 million in short-term investment, but I considered 15 million as equivalent. They also have $3 million in long-term debt. So the enterprise value is $109 million. Over the last 4 quarters, their trailing 12 months earning was $15 million, which gives them around a yield of 14%. So basically you have let's say a PE ratio around, let's say, I don't know, 7 or 8, which is actually very good. Regarding the pricing metrics, price to sale 1.1, EV to sale 0.9. They also have a price to book lower than 1. And what is actually very interesting is that the return earning of over the last 25 years was $64 million. So you can see that this company is actually very reliable on the long term because they have generated really money. A lot of companies today, if you look at the stock market, they are growing, their share price is increasing, whatever, but you see the return earning is negative. So that's also a strong point for them. Again, on the balance sheet, I don't see anything wrong. They're increasing basically the rig numbers, so the plant, property, and equipment is increasing quarter over quarter. And here, this is summarizing the last 4 quarters. Regarding the cash flow statement, you can see that from 2018 till now, they generate each year a positive operating cash flow, which is actually very, very positive, even during the COVID phase. And in yellow, which is the investing part, is basically the capex. So you can see that they are mirroring their investment compared to the operating cash flow. So if a year is actually $8 million in positive cash flow, they will invest more or less the same on the capex. So very wise investments. Sometimes they raise a little bit of debt, and sometimes they reimburse it whenever the cash is higher. So you can see 2021 actually was one of the highest capex investments. They generated so much money that they reinvested directly into the business, which is to me one of the best way to use the cash efficiently rather than just giving a dividend or buying back shares. Regarding the income statement, which I summarized here over the last 4 quarters, you can see that the gross margin is hovering around the 20 to 30%, and net income between 6 and 18%. But on average, over the last, let's say 4 quarters, the net margin is around 13%, which is quite good and very strong actually. We know that there's a little bit of cyclicality in the revenue during the year. The reason being is the weather impact, which actually on Q2 makes the revenue higher because it's a dry season in West Africa, and the wet season starts in Q3. So you always have a step down on Q3 compared to Q2. However, you know that Q2 is a strong quarter, and actually the CEO announced on one of the interviews that the revenue would be higher than last year, so you could expect to beat this number for next quarter. So actually it would be a good catalyst. Regarding the capex, so for the first 3 months they invested $4 million, and they expect actually to have even more capex invested. Reason being is that they expect revenue growth, more net income, more money, so they will invest directly. Overall, I think that's it. Maybe just the last one is regarding the operating leverage. As I was mentioning, the gross profit year-over-year increase while keeping the SG&A pretty steady. So that's actually comforting what we were seeing on the slide presented from the investor presentation. So here it is. This is the overall DNA card. I think it's a great one, strong one. And now we will go to the next step, which is how to estimate the share price based on the guidance that the CEO gives. And let's see what ratio we will use for that share price estimation. But before going there, I just wanted actually to be sure that because they invest into property and equipment, I wanted to be sure that the depreciation was included into this gross margin or OPEX, which is actually the case. So if you want to look into details, For Canadian company, you have to go on the website cedar.com, and then from there you can extract anything. This one is an extract from the last quarter, and you can see that the depreciation is actually part of the cost of sale. So meaning that the gross margin includes already depreciation. So that's good. For those who are not completely, let's say, familiar with the depreciation, is basically if you're a taxi driver, you buy a car for $500, you know it's gonna only last, lifetime will be only 5 years. It's exactly like if you do a $100 investment every year, and that's it. Here also was the cash flow statement, and actually I wanted just to share that with you, like a concept, is that as we saw that the net income already includes the depreciation, whenever they go back into the cash flow statement, they put the depreciation back to the operating cash flow. Why? Because actually on the investing cash flow, they use the CapEx as a loss. So you don't want to count double the CapEx and another time depreciation. That's why they add it up. That's something I struggled with over the last, let's say, years to understand, so I wanted to share that with you. Now let's go back to the guidance that I was mentioning about you. So sometimes guidance is not super clear. On some companies, it's very easy because you can look at the press release on every quarter they announce, like, they update the guidance. Here it's a little bit more tricky. I had to look into different CEO interviews. And then on one of them, which is an interview made by Radius Research, so I will give you the link in the description. He announced that basically there could be a 10 to 15% revenue increase, which gives you around $130 million estimation. He mentioned also that the EBITDA margin would be unchanged, so I considered maybe the net margin as also similar. Mentioned that also when he mentioned about these numbers, it was really in a ballpark that he was sharing, and also sharing that it was like conservative numbers. So actually it's quite good, because you want to be conservative when you do a share price estimate so that you don't get disappointed. Okay, so let's go now for the valuation. I used the typical process that I use for the other company, like Crocs, which one was Charles & Covered, and also SMSI. You can see also on the past videos, I will use exactly the same process. So basically the revenue is split in different sections: cost of product, SG&A, R&D, and then after you have only the net income when you remove the tax. Whenever you have the net income, you divide it by the number of shares, which gives you the EPS, earning per share number. Once you find a P/E ratio to apply on that company, you can estimate a share price. And then the last point is you do just balancing with the cash or debt that the company has to estimate a final share price. So let's do this exercise with the past guidance that the CEO was sharing with us. And he was estimating $130 million. And now for the net margin, I wanted to use the same as the last trailing 12 months numbers, which was 13%. So obviously the net income actually is $17 million, not $20 million. And when you divide it by the number of shares, which is 50 million shares, you have an EPS of 0.30. Now, here is the, let's say, art coming into the science, is what P/E ratio do you apply to a company, a mining company. So usually the P/E ratio is quite low. But however, this company has actually a very good balance sheet. To me, I would consider a P of 10, considering that they have a good backlog, that they are doing expansions, that I will mention in the conclusion. But for me, a P of 10 is like a fair valuation. When you have this, you guess a share price of $3.4. And now we need just to add the $15 million of cash that they have, which gives you an additional $0.3 to add on top of it. So the final share price would be 3.4 plus 0.3, 3.7 US dollars. Don't forget that the company is reporting in US dollars. My estimation is in also US dollars. So but the company is trading in the Toronto Stock Exchange, which is trading in Canadian dollars. So you have to do the conversion from USD to Canadian dollars, which gives us a target here at the moment of 4.7 Canadian dollars compared to 2.5 today. Now, because I prefer to give you, for my estimation, for my exercise, I prefer to give you a range of price target rather than just a single point. So I considered a more conservative approach, which was considering a P of 8, just to be a bit on the lower, like on the more conservative side. And by doing the same exercise, I end up with a share price target of 3.8, which is actually lower, which is normal. So now let's go to the conclusion. Here I want to just to give you a big picture before going to the chart and show you the possible return over the next. Company is profitable. They have a good operating leverage. They have a PE around 7. They secured also more contracts, which give you like a good backlog, good booking, so securing a little bit more the future. The guidance from the CEO also was around plus 10-15%, so it's a double-digit revenue growth. $130 million is a conservative number, but it's good. It's good to be surprised on the positive side. Also, the CEO has been there on the long run, meaning that they've been there. He's been there since day one. He's accumulated experience. He's also the major shareholder of the company. So meaning that whenever he takes decision to invest into capex or to do buyback, he will do exactly it just to protect also his wealth. He's got 40% of total shares. He don't want to dilute for a stupid reason. He doesn't want to buy back if the share price is too high. So it's really good to have somebody that has skin in the game. It's a true asset for the company. Also, let's mention this extension of the buyback program for 2022 and 2023. Let's see if they generate enough cash. I guess that the CEO, if he, for example, invests, I don't know, $20 million in capex, but still generates, for example, $25 million in cash, and that the share price at the same time is low, I would not be surprised that he would put a little bit of this money into a buyback. For information, I think they have not done any buyback since the inception of this company. By looking at the not income statement, by looking at the numbers. Next point. Apparently, so the CEO has mentioned that there was like a down cycle for 7 years, and then usually the up cycle mirrors the down cycle. So the expectation is to have the next 5 to 6 years on an uptrend, and that's possibly the reason why the CEO is actually investing already strongly just to not miss this upside, this upcycle. And also, they are doing two types of expansion. The first one is the geographic expansion, as I was mentioning at the beginning. This is just a map from their website. I just added the number of rigs based on the last interviews that I was actually listening over the last few days. They already have 3 rigs in Egypt, 7 rigs in total for soon. And in Peru, they already mobilized 4 rigs. So it's not just a promise to, let's say, develop or expand, it's already happened. On top of geographic expansion, they want to do also vertical expansion. And it comes from actually the fact that West Africa was mostly mining for gold, but Peru, for example, will be more, or South America, because it's just the first country. They might expand maybe in Brazil or other countries. The target there is base metals, for example, copper, or EV metals. And that's actually a new business that is just getting bigger and bigger. So more EV numbers, meaning that they will need more different type of metals. So it gives diversification, a more total addressable market for the company. And because they have so much experience for the last 20 years in drilling, I think they can potentially reproduce easily the model in West Africa to South America. Also, another possible catalyst, which is actually not bad, is Q2 is usually the dry season quarter, so you can expect to have maybe a possible record sales in Q2 compared to the other quarters from the last years. This will possibly give a boost, let's say by June or July, to the share price. Just on the negative side, I have to mention possibly supply chain impact. You lose money, you lose time, the margins get lower, but the supply chain issue is already there, so I don't expect to have it lower. The net margin is still 13%, and actually, okay, I don't see that as a big issue, but let's follow that. Also, the oil price, obviously, it's one of their main consumable for the rig activity. So let's see if let's follow that also. And one of the last point also is, okay, the PE ratio for mining companies is usually very low. So do I overestimate the PE ratio in the price target? I don't know. To me, a company that is growing, that is expanding, that has a very good balance sheet, and that does not lose money on the down cycle, to me deserves a PE a little bit better than the peers. Now let's finish with the chart and targets that I was mentioning while doing the operating model. So let me zoom in. So here's the video that I just put, and then the share price at the moment is $2.48. And I put this target window. So P of 8 will give you $3.8 and a P of 10 will give you $4.7. Here I just also put the lines to estimate the compound annual growth rate. So this window actually is in March 2023. I put this especially on that date because this is where the company releases the last quarter of 2022, so that the guidance, actually the full result of 2022 is announced. So it does take 3 months more. And basically the compound annual growth rate could be from 73% to 120%, if of course my assumptions are correct and the market responds positively or values the company the same way as I do. They're also on upward channel, ascending channel, and at the moment we are right at the bottom part of the channel, so it will give you also maybe an additional, let's say safety on the fact that it's not trending too high at the moment. So I think that's it for today. I hope you enjoyed as much as I did. Give a comment. If you follow that video until the end, maybe give a like. I will never refuse them. And I think over the next months, I'd like actually to update all these companies that I'm actually following, just to see if the story is happening, and also if, for example, the share price is not reached, why did it happen? Okay, I think we need to learn always from success, but more from failures. And I think this is really what I want to do, actually, to put, let's say, to insist on this channel is possibly maybe I will do another, let's say, video, for example, here to see what will be the next guidance and where we are at the moment. So this is important to learn from the lessons, not just suggest something and I just go on another ticker. So I will provide follow-up on each of the tickers that I have been mentioning. Okay. So I think that's it. I won't use your time more. Enjoy your day and then see you soon on another video. Ciao, ciao. Bye-bye.